Hello. I am remaking the Alibaba video because there was an issue with the latest recording. So, Alibaba has spent about $17 billion in an AI bet and cloud infrastructure bet over the last year. And it is currently at a stage where it's spending a ton of money, generally speaking, trying to increase business. Now, you will notice that management is funding the dividends and buybacks of the company because they are doing both quite a lot, using debt and convertible notes because the actual business operations aren't generating enough cash to cover them right now. China e-commerce profits cratered 76%, so this part of the business is not doing well. On the other hand, the quick commerce side, which is like delivery services, is growing. However, there is a little bit of a hidden fact here, the fact that they are using heavy discounts to get those sales. So they don't say how much, but as I've mentioned in the past, it's not a good idea to use subsidies to increase the top line of a company, increase the revenue. It's kind of artificial. Now, if we go back, you will see here that the marketing spend has also doubled to keep customers, and so the company is actually has to keep investing into marketing to keep the acquisition of customers happening. So the customer acquisition costs are pretty high right now, and also investment gains are propping up the bottom line, and this is a new thing that happened recently. There is a change. Initially, investment gains were part of comprehensive income and not the net income of the company. This has changed. This is included now. Generally speaking, this could mean that you have some volatility in net income because of investment gains in some situations. Okay, so these are interesting, but we also want to take a look at the financial statements to see the finer details because these tell us the progression of the story, what has been happening. And so the total revenue of the company, even in the quarters here, you'll see it's pretty high, and they haven't really lost revenue, which is always the most important thing to begin with. And even if you take a look at the annual, actually, you will notice that their revenue has been increasing through the years and increasing nicely from at some point 15 billion to almost 140 right now. So that's TTM, and that has been increasing tremendously actually if you take it back like 10 years or so. So solid stuff here. Now, the thing that we talked about is the fact that they're spending a ton in selling and marketing. Used to be 2 billion back into 2016. Right now, it's sitting at 28 billion TTM, and 2025 was actually 20. So it's the last couple of quarters or so that this has grown quite a lot. Actually, almost 8 billion here. So that's something to absolutely notice here. And the operating income has suffered a little bit again because of what we said about the company spending a ton of money, pretty much having a lot of operating expenses. And so the other thing that is interesting to notice is the fact that the net income, generally speaking, hasn't been suffering. Aside from the fact that this was happening in the COVID years, understandably so. At some point it was like 11, then went to 22, and then there was, the crash pretty much for the company. This is when we bought, and hopefully you did, and made some good money. And they were making 7.4, but it was a period where everything was going wrong for Alibaba, including the Chinese government giving them headaches. Right now, this is absolutely turned. So 7.4 then, 16.7 TTM, 17.4 FY 2025. So getting to territory that they used to make before things happened. Now, balance sheet of the company is another interesting case because you will notice the cash and cash equivalents and short-term investments here, which are usually like what you can liquidate within 12 months, or this is actually already cash. And if you take a look at 2021, they had about 80 billion of these, but now latest quarter is like 40, showcasing how much they have been spending. So there's a big spend going on, and you can also see that if you take a look at the liabilities of the company, like the total liabilities of the company have been increasing quite a lot too, from about 17 billion back in 2016 to 108 right now. So steep increase, and especially the latest quarter, about 10 billion increase compared to FY 2025. So another interesting thing to see. Now the cash flow. Cash flow is another interesting case here that I wanted to talk about because you will see that it has been affected a lot because obviously of capital expenditures. At some point, In 2016, the company was barely spending stuff in money in capital expenditures, less than a billion. But right now, we're looking at 18 billion in the last 12 months. So steep increase of how much they are spending, and we saw why. We saw the story. The free cash flow from 8 billion again in 2016 right now to 165 million. So actually losing a ton of it because they are spending a ton of it. And especially TTM is very low. Like 2025 was low, but not that low. But TTM is very low, and you can see in the quarterly reports, you can actually see the exact numbers, and you will see what they have been spending. Because of steep capital expenditures, this is actually negative territory here. So you will see, and you notice that the company has been spending a ton here, trying to keep up with AI and infrastructure and cloud, spending a ton of money trying to invest in themselves. So that's not necessarily bad, of course. It may actually be a very good thing, but it's worth noting exactly what the company has been doing, and this is what the tool helps you with. Now, the P ratio of the company has been going down, and this is nice to see. At some point, when I bought the company, it was actually like, I believe at some point it was like 14 or so, and then it started growing with the stock price growing as well. The outstanding shares of the company have been going down, as I mentioned. The company is actually buying a ton of stock back, and they are also paying dividends, and they actually even more borrow money to do that, borrowing money, because a lot of spend is going towards, again, investment in the business. These metrics here are very high because of what we saw, the free cash flow being very, very low right now, and this is why they become so high, just because in the latest quarter, this was like just a few million. The revenue, net income have been increasing nicely, understandably so. The equity is also down, understandably so, because of a lot of buybacks. I mean, it's understandable. Free cash flow, the same thing, 167 million right now, going low. Now the margins are fine, are looking really solid here, which is nice to see, apart from the operating margins, understandably what we saw earlier, and obviously EBITDA is also affected by this. And the returns kinda low for the company, generally speaking. Now, the other thing that we want to examine for sure is, first of all, the AI deep dive gives us the full story. So if we take a look at the key stories, we see what has been happening, what is key in this quarter, and the things that we already talked about, but it's nice to summarize. Spending big on AI without too much profit to show for it right now. And even if you take a look at the investor language here, you will see that they are spending aggressively and roughly about 17 billion over the past 4 quarters. And so that pushed free cash flow into an outflow that we saw 167. No, actually, that's the outflow for the quarter. It was like a few billion. The catch is cloud's adjusted profit is still small, for now at least. Now the AI cloud growth, let's actually go back to casual. It's more easier to understand quickly. The cloud business is definitely getting bigger, bringing in a few billion. Again, that's about 17 this quarter. And the AI tools are exploding in popularity, with Gwen being the big guy, I believe. Here's the thing, while lots of people are using the models, Alibaba isn't telling us exactly how they are charging and what their profit margins look like, so it's almost like a secret thing here. Remember, this is a foreign company, they don't have to tell us everything. Fast delivery, at least not in SEC. Fast delivery grows fast, but the costs are hidden, what I told you earlier about the subsidies, and paying shareholders by racking up credit card debt. Pretty much the debt that I mentioned a little bit earlier, so to buy back stock and stuff. So yeah, this gives us the full story of the company, but now we can analyze deeper. Before we do that, you can see in the overview, which is also interesting. I like to see the top concerns and key strengths. The negative free cash flow driven by AI, sales and marketing experience doubled, earnings quality masked by investment gains. Yeah, exactly what we saw. Market leadership in China cloud, large cash and liquid investments still, even though they are spending, and massive ecosystem scale, of course. Now, we will go a little bit more ballistic here and be almost act like an analyst sort of. So this is going to be a little bit more advanced, but hopefully you will enjoy seeing these metrics here and the information that they can offer to you, because they can really show you interesting things about the company. The margin trend of the company, the margins have been expanding, generally speaking. That's the operating margin. However, in the latest quarter, this has been going down 2.2 right now. Generally speaking, you see pretty high margins and margins that are increasing, but you had some weakness here. Again, understandably so. They have been shrinking for a reason. Now, the capital efficiency of the company tells us If I spend $100 in a business, how much I'm getting back? And this is the number. That's return on invested capital for the company. Think about it like $10 on 100, pretty much. Like, what is a return on invested capital? And this may sound all fancy, but if you think about it simply, it's actually pretty simple. What is capital for a company? Capital is debt, the amount of money that you get from debt, and also the amount of money that you get from investors buying your shares. And so debt plus equity is what you'll see online, for instance. And this is simply what it is. So the return on equity is basically how much money you make on deploying this equity. And so this is about 10% here, $10. Now, if you take a look at the card here that explains the return on incremental invested capital, also you will see it's 32. And this is a really positive sign. Why? Return on incremental capital is how much I make on new invested capital. So think about it sort of like the ratio of changes, pretty much. So we add new capital, how much am I making on this capital compared to the old one? And so the new one is about $30 compared to the older one, meaning that the company's expansion makes sense, it's meaningful, they're making more money on it. Very important metric here, and very important to see incremental margins. It's a thing that investors don't really know about. Actually, they should care. They should deeply care, but they don't really know about. And the tool here gives us exactly the number. Okay, so incremental margins is the same idea, but for margins. So if I'm making $100 in revenue, for instance, what are my margins? How much of it is profit? And so here, again, it's like $14 usually, but the incremental one is $24. So basically, the new sales that I make do better than the old sales that I make, pointing to the fact that the company could still keep growing because they are making more efficient revenue, pretty much, and efficient margins. Know what I mean? Okay, and it's also stable in Q2. Now, the earnings quality over here have suffered, understandably so, because it's the operating cash flow divided by net income here. So it's how much of the profit is cash. Now here, this has suffered because of the weakening. Again, we saw it, operating income, but generally speaking, has been doing well. This one is understandable, both ones here in terms of number, because of free cash flow basically suffering. And so this has been going down, has been deteriorating, the margins. Understandably so, we saw it, the company spending a ton. And also in owner's earnings, which is how much of the owner actually pockets after pretty much everything is paid for, you will see that this has suffered, especially in the latest earnings here, just because there is less real cash pretty much coming out. A lot of it is being spent. And so there's heavy capital needs here. Understandable and expected. Not necessarily bad, by the way. This gives you the story of the company. And I don't think it's bad, actually, in the case of Alibaba, frankly. Now, debt coverage is always important. Alibaba has zero troubles here. Even though they are getting debt, they have a lot going for it. So a lot of money to pay it back pretty much. And it has been the same story for many years. So not a big deal here. The share dilution, though, it's interesting and it's good for investors. This is something that you'll have to see. At some point with the company back in 2021 was actually issuing shares, I suppose when the stock price was high still, but then started to actually buy back and retire shares, which is very important. And so now, if you own stock since, let's say, 2022 here, now your stock is intrinsically worth 11% more because there is less of it. How much less? 11%. So this is something that you'll have to see as a shareholder. Now, this is not necessarily true about the 11% thing because there are other factors which come into play, and you'll see them here with the rest of the cards telling you the story. This is stock compensation, for instance, employees being paid stock. Now, this means that when you are retiring shares, you can actually use these to pretty much pay employees. And so some companies sort of like buy them back to actually give them back to employees. And so it's a cheaper and like more tax efficient mechanism that a lot of tech companies do. Now you will see that for Alibaba back in 2021, the percentage of revenue for SBC, which is stock-based compensation, was 7%, very high. But now it's 1%, 1.6, getting much more efficient than what you like to see as a shareholder. I like to see that a lot. And in combination with this, this is even better because this tells me, okay, the company is buying back shares, and we know that, so they are buying back. But are they actually giving it back to employees, or are they actually retiring the stock, becoming treasury stock, pretty much making my slice of the pie larger? And this is exactly what is happening here, and this is what the card is telling you. And also the share count is flat for Q2 2026 as well. So this is very nice to see, because now you know that the buybacks actually mean something for you. They're actually meaningful. How much of the balance sheet is goodwill from acquisitions is what this answers. Basically examining Alibaba's acquisitions and seeing how much they had to potentially write down as failures. This is not a risk here for Alibaba, and this has been pretty solid, and it's doing even better here, and even lower in Q2. So not a problem here for Alibaba. As you see, the numbers are actually going down. Inventory bloat is not something that Alibaba has troubles with, and they wouldn't probably even be reporting a lot of numbers here. Receivables quality is about the amount of money that you get from suppliers, for instance, from customers, for instance, from clients. How fast are they paying you, for instance? Now, this is mostly relevant for a company like Amazon, for instance, who would have like customers and suppliers a lot, but probably not so much for Alibaba. Still, they are sitting at about 74 and improving, so nothing to worry about here. Asset maintenance, capital expenditure divided by depreciation ratio, pretty much. So this simply means, okay, we have some assets here. Is the company paying back money to effectively not allow depreciation to keep happening? So are they actually replenishing stuff? And Alibaba is not only doing that, but it's actually investing in the future. And the card actually sees that and mentions that. So recognizes the fact and says building for future, investing more. Is exactly what we see. We're looking back into like 2020 territory, which is what's happening today. So this is ambitious and looking good, very solid. Accruals, this is a little bit more complex. It tells you for every $100 of reported profit how much actual cash came in. And you may be thinking, okay, how could this be more here? And why is the cash quality stable right now? Now, if you take a look at the card, you will see the finer details. This is a little bit more advanced, because take a look at this. If a company, for instance, reports $100 in net income but only generates 60 million in operating cash flow, where is that 40? Well, what's that 40 about, this cash profit? The reason why having high accruals is a red flag, it can be an accounting thing, like for instance, aggressive revenue recognition here. So you have booked sales before cash is received. And you are shipping excess products to distributors and calling it sales. So understating reserves, capitalizing expenses here, calling costs assets, pretty much. So some inventory accounting games. Now, for instance, this is what Enron was doing back in 2000, and they collapsed. So they were reporting billions in profits, but operating cash flow was terrible and declining. So by 2000, they had massive accruals, over 1 billion gap between net income and operating cash flow. And there was a fraud, because they were booking profits from long-term energy contracts immediately using mark-to-market accounting, even though no cash was received for or would be received for years. So you can see it was like a books fraud, pretty much. This is what this would capture here, and extremely useful, a metric of this sort, which looks fine here for Alibaba, no big deal. Depreciation adequacy is. This is also a little bit more advanced, and it's what Michael Berry mentioned. You may have heard about it some time ago. He gave a big flag here, a big red flag, about companies depreciating assets slowly, very slowly, more than they should. Again, let's learn more so that you see exactly what is going on. If you have like a $10,000 server, for instance, and you depreciate it over 6 years, what does that mean? Depreciation over 6 years means that it's losing value, basically. So you have to write down some of its value. And so what typically happens is a schedule. There's a schedule over years. So this is if they decide to depreciate over 6 years, the usable life of an asset that is, you would be expensing it with $1,600 per year. But if it's only really useful for 3 years, because these things, depreciate fast, like a new memory card, a new server comes out every year or so potentially. So the old one could be obsolete very soon. You should expense $3,000 per year. So the difference is going straight into profits because it's not an expense anymore. So making earnings look better than reality. Makes sense? And so this is what, for instance, Google has been doing a lot. And so if you take a look in our tool, which you can, by the way, it has a free account and you can join in stockainsights.com, you will see that Google actually has very high depreciation adequacy because their schedules are really high. Now, notice that back in 2020 they did have a very high schedule, about 15 years, but now it matters even more with the latest advances in AI. So right now they're sitting at $8, which I think is fair. Tech has an about benchmark of 6 years, and this is curated by myself and some research, of course, that I made. Different industries are going to have different depreciation schedules. So, for instance, if you're depreciating machines like a tractor, for instance, that would depreciate much slower. It could be many years, decades even. But for servers and things of that sort, the implied asset life probably about 6 years or so. So we have a benchmark here and we actually compare against that. So this is about a 3 here. Not great, but still not terrible for Alibaba. And the Altman Z score shows us the risk of bankruptcy. Always nice to know about companies. Anything above 2, pretty much, is pretty awesome. But anything above 3, sorry, 2.99, I think, is the baseline that makes it really good. But this is 3.63, so the Alibaba doesn't really have any problems here. And it's actually even getting better in Q2. It's a company that I think basically will keep growing through the years nicely, frankly. Now, the stock evaluator tool is the last thing that I'm going to do, which examines, okay, we have cash flow here, and even though it's being spent a ton on capital expenditures, what's the intrinsic value based on the cash flows that the company generates is what this is responding to. And you will see that I'm doing the Stock AI Insights Lucky 13 automatically here, which is the featured scenario, and using the predetermined values. Like, you can select different scenarios, and all of these have specific reasons why, and being explained what they use. I have curated all this myself for specific reasons, each one. And this one is, I think, the one that makes the most sense, frankly, for me. And this is the one that I use because this takes the revenue growth of the company through the years, the average, and the free cash flow margin through the years, the average, which you can see here. It's a revenue growth about 14% on average, 5-year average. The free cash flow growth on average, the margins have been 17%. And so this goes somewhere in between 14, 15, 17, 10, 14, 17. Understandably so, right? And the required return about 13% is exactly what we want to go for because an index fund will give us like 10%. We want something better, obviously. And if we calculate the intrinsic value of the company, you will see that we are sitting at about 172 right now, as the stock went down a little bit yesterday. So this became green marginally from the recent video that I made, understandably so. But this signals a company that is probably around a spot where it's fair value compared to the cash flows, but there is way more to it because a company is not only its cash flows, right? I've mentioned it multiple times. There's many more things. And I do like the fact that they invest. They are in a story right now where they are trying to become a big player, actually, in the AI and cloud infrastructure. It's a little bit of a bet, but they do have the money to show for it, and they do have the mode to show for it. So I think the company will actually keep going nicely through the years. I have good faith in Alibaba, and it has been treating me well so far in the past few years, more than doubling, pretty much. Actually being slightly down right now, but still effectively being quite high compared to where I bought it at, which was less than $100 back then. Okay, so thanks for watching, guys. I hope you enjoyed. Again, sorry for the original video. There was an issue with OBS, my recording software. So thanks for watching. Leave a like if you enjoyed this, and let me know if you want me to examine a specific company. I can examine all. The latest tool that I have has pretty much all data for all companies that file with SEC, Edgar SEC. So if they file in the US, I got it and I can make a video about it. And it's going to be this kind of numbers. It's going to be really detailed because it has been studied with AI. So yeah, the tool has been fantastic. Thanks for watching again. I'll see you soon. Bye.